Welcome back to the program Business Daily on Trust TV. Now, before the break, I said we're looking at the story there. Our first story, our top story, IMF has lifted Nigeria to 3.4% economic forecast for the year 2025. This is from their latest July World Economic Outlook report that was released. Now, in April, they put us at 3.0%. So that means we've gone up by 0.4%, an increment. However, they're still saying that we will go slightly down to 3.2% in 2026, which is equally an upgrade with 0.5% from their April forecast for 2026. Now, let's just get into the conversation. Now, the International Monetary Fund has revised our real GDP for 2025 growth projection to 3.4%. This optimistic revision is underpinned by stronger global financial conditions, reduced trade, tariff pressures, and resilient external demand. Now, the IMF is expecting growth to moderate slightly to 3.2% in 2026, 0.5-point upgrade from its April forecast. Why the upgrade? It says boost in oil production and the commissioning of a new domestic refinery. Apparently, the coming on board of the Dangote refinery is helping. Now, the continued strength in the services sector and stable macro environment, tight monetary policy, improved FX market operations, and renewed portfolio inflows. However, the fund is warning of a downside risk. That's the oil price volatility, external financing shifts, and shock from weak global demand could derail growth unless reforms persist. Now, let's look at the economy in context. Nigeria, in quarter 1 2025, GDP growth stood at 3.13%, up from 2.27% in the same quarter last year, 2024, led by services and industry gains. Despite expectations, agriculture underperformed due to security and productivity challenges. Now, the broader IMF guidance also calls for tighter fiscal discipline, subsidy reforms, and scaling of social safeguards to address vulnerabilities. Joining me on the program this morning, virtually from Kano State, is Dr. Emmanuel Bashayi, an economic and business consultant. Good morning. Thank you for joining us.
Thank you, Chiamaka, for having me. Good to see you again.
Yes, good to have you again. Now, you've heard me reel out all that information. And first of all, what's your take on this upgrade from 3.0% now to 3.4%, seeing as we have about 5 months for this year to come to end?
Sorry, Chiamaka, your audio was quite low. Can you say that again?
I said, what's your take on this upgrade, upgrade for forecast by the IMF for Nigeria from 3.0% to 3.4%?
Right. So whenever there is an upward review of a forecast, it means there are certain postulations that the organization is anticipating that will level out towards the end of the year and would give a more positive outlook. While the assumptions are things that we want to look at more closely, it's also very important to say that if we continue on this trajectory, then that will be a destination we should be aiming at. But I'm also a very conservative person when it comes to lovely and lofty statistics. I'm not someone who believes that there should be happy statistics and unhappy people, right? The statistics should be able to have a reflection on the people, okay, because that's the ultimate measure of those statistics. So it's a very ambitious growth expectation, one of the highest in the world today. But then I will take it with a pinch of salt. I mean, I think I've mentioned that in some of our sessions. It's good to pursue that. It's good to look forward to it, but I'm also very pessimistic on whether it's going to happen or not.
All right. Now, I want us to go back a bit and go elementary in this conversation. Now, could you explain this in a way that the tomato seller in the market understands when they say the IMF has decided to do with, upgraded our positive outlook? What does this actually mean for that person who's selling pepper, the SME person, the tomato person, the bricklayer out there, the mason? What does this mean exactly?
So economic growth is typically a function of GDP growth. And to put it simply, GDP is the sum total of the goods and services produced in the country within a certain period, typically a year. So the productivity of the mason, the profit of the tomato seller in the market, the gains that the shoe shiner makes and all, they add up to our GDP. Typically, it's an estimation. I mean, no exact numbers. These are typically estimations. So the idea is that if the mason makes more money than he made last year, and he's able to take care of his bills better this year than last year, without inflation killing the whole thing, then it means we're growing. Okay. So I made 10,000 naira last year. Now I'm making 12,000 naira. I am growing my income. That shows that those are the kind of things that add to say our GDP is growing, because it's a sum total of the goods and services we produce within a certain year. So if the market woman is able to see better revenue in her business, okay. So better revenue means better profitability, to put it mildly, as specific as possible, meaning that if she's making more money now, and the money is able to give her the things that she could afford last year. Let me give you an example. Last year, you could buy a plate of food for 2,000 naira. Now you are buying the same plate of food for 2,500 naira, right? That is for almost a 20% more, or to 20 or 30% more than what you were buying it last year. Now, you used to make profit of, say, 10,000 naira last year. Now you're making a profit of 12,000 naira. That takes you to a 20% profit increase. However, you have a higher increase in terms of inflation versus your income. So the 12,000 naira now is not able to give you what 10,000 naira could give you last year. This is the implication. So while we will be growing at a certain rate, it's also important to juxtapose it versus how inflation is also catching up with that growth. That's the most simplest. That's the simplest way to look at it. So it's good to be excited about the forecast and the growth expectation, but it's also important to understand that the things that take the money away, how well are we able to deal with them?
All right. So now, earlier when I was speaking, the IMF is calling for tighter fiscal discipline. Now, you've mentioned us achieving this. Now, my question is, what fiscal and structural reforms can we as a country take to be able to meet this and even surpass this target?
So, fiscal discipline is very key. Let's focus on getting our budget line, budget discipline as tight as possible. We cannot do like this in that situation where we say the country doesn't have money and then we're still living the kind of life we're living when things were better. For example, if you used to earn 100,000 naira as salary, and you were living a certain life, now you earn 40,000 naira. You still want to live the same life that you were living when you were earning 100,000. There are two things that are going to happen. It's either you borrow to meet up with that, or you simply cut down your expenditure to your current income. So this is what Nigerians seek to see. Is our government spending in a way that reflects the realities of our economic situation? We keep saying, let the people make sacrifices and more. Is the government equally making sacrifices? We have seen some of the biggest budgets. We have seen some of the biggest spendings in areas that doesn't suggest that we are broke. So it's difficult for the people to have to reconcile how we are broke versus how we spend. All right. So this is what is on the minds of people. We need to have the right fiscal discipline to say we will cut down on expenditure on non-relevant things. We will put in more money in areas that we believe is going to drive more value for Nigerians. We have removed fuel subsidy, yes. Where are we channeling the money to in such a way that the Nigerian is able to see the visible impact, and it will compensate for the loss of that incentive that he used to get from fuel subsidy? So it is a combination of all of this that shows that we are frugal in our spending. we are making people at the top that take the decisions also making the right sacrifices to ensure that we're able to, as a people, make progress that we need to. This is not going to be on wishful thinking. We cannot continue to wear the same agbada as we used to wear now that we don't have as much money. The monies are not as much as they used to be. Yes, government is getting more revenue, but then the inflation is taking over so much of it. And most importantly, we need to understand that we have just a limited resource base that we need to appropriate in the best way possible to drive the most results.
Okay. Now, in the statement or the report, rather, they mentioned that agriculture underperformed due to security challenges and productivity challenges. Now, I want to ask now, how will the agricultural sector and equally the power sector, how will it, drive growth for us as a country? I know that we say when these things happen, especially for energy, if you know that you're not going to have to spend so much money trying to make up for energy since the power is not there, you might have to save more, and your business might get to do better and all that. So you as a business consultant, tell us, how will the agricultural sector and the power sector, very important, impact these numbers and even impact our economy?
Right, very important question. The first thing is when you think about agriculture, you're talking about food security. Now, our inflation today is majorly driven by food inflation. Food inflation is the largest inflation item that actually drives our food inflation number. And like I've said severally, food inflation is driven by insecurity, because the farmers are not able to go to the farm to farm as much as they used to. So there is a reduction in the supply of food. So to address food security and as well, ultimately food inflation, we need to address the trigger, the thing that drives it, which is security. That's number one. Number two, talking about power. Power is what drives manufacturing. We need power to run the factories. We need power to run the industries. We need power to run the economy. Now, if power is expensive, it goes back to the cost of whatever you're producing. So I gave you an example some time ago how a hotel said they used to pay 2 million naira for their electricity bill in a year. Now they're paying 11 million. So that directly goes back to the cost of what they charge for a night service and all of that. So this then goes back into driving the inflation numbers, because I used to pay so amount of money to lodge in a hotel for a night. Now I'm paying 2 or 3 times that amount. So if we address power, it means that the manufacturer will get the power at a cheaper rate. And when he gets a cheaper rate, he can be able to translate that cost back to the consumer. So the consumer will now pay relatively less than what he used to pay. And so he's going to have more value for the money in his pocket. And by that, we can now begin to tame inflation and then have a backward, we begin to have a slowdown, and then see how we can also retract and then tame the inflation as the case may be. So if we fix insecurity, we'll fix food security. And if we fix the cost of power, we will then be able to help manufacturers produce at a lesser rate, and then the final consumer can get those products or services at a relatively cheaper rate too.
All right, now, so for our final question, the 3.2 forecast for 2026, how does that impact long-term investment for Nigeria?
Right, so long-term investments, I have said this, that transparency, longevity, and consistency is what the external investor is looking at. It's not looking necessarily at just the exchange rate, as the case may be, but it's looking at how stable it is. So he's more concerned about, if I bring my money at a certain rate, when I want to repatriate funds, I should to repatriate them at a certain, and that at a rate that is not so dramatically away from that window. He's willing to take a certain window to be able to repatriate funds and exchange the money into his foreign currency and then move it back. So if we are able to keep exchange rates stable, possibly seek to see the naira appreciate, because we now have better production locally and we'll have less dependence on foreign exchange, then we are way on our way to where we want to get to. So it is important that we keep our eye on the ball. Growth is good, keeping all the indices very stable, keeping monetary rates very good and stable. That way, investors and foreign direct investment portfolios are able to see that level of stability, and that is their major attraction. Remember, we have a good population. We have a very sizable population that can support pretty much every business. So population is a good advantage for us. Yeah. But when the macroeconomic indices are not particularly very stable and consistent, it then becomes a red flag for investors. So we should invest more in keeping them stable, keeping them consistent, so that we can be able to get the real investments that can be the main driver for our economy.
All right, thank you so much, Dr. Emmanuel Bashayi, for your insights. It's always a pleasure to have you on the program, sharing your insights on the conversation and our economy here in Nigeria.
Thank you for having me. It's always a pleasure.
And that's it for Business Daily this morning. We've been discussing the IMF's forecast from 3.0% projection to 3.4% for a Nigerian economy for the year 2025. That's what we're talking about this morning on the program. And that's it for us this morning on Business Daily. For more of our programs, documentaries, and news, do want to follow us on our social media platforms and on our YouTube live stream. I've been your host this morning, Chiamaka, Nwanfor. Same time, same place tomorrow. Bye for now.